From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. Joining me, as always, are my co-hosts, Brendan Walsh and John Fagan of Markets Policy Partners. Hey, guys.
Good morning.
Hi, Ylan.
Good morning. All right, so today we're going to talk about the Fed and the apparent cool down in inflation, but I want to start with a look at the banks because we spent a lot of time on this pod talking about all the problems in the mid-sized and regional banking sectors, but now the big guys are reporting results, and Brendan, so far it's looking pretty good, right?
Yeah, so we got Wells Fargo, JP Morgan, and Citi. So that gives a very broad view of the economy because Wells Fargo is very domestic. JP Morgan's a little more global, but Citi's very global, especially in the emerging markets. And all three of them, there was a lot of concern coming into these earnings that we could see some deterioration in credit, maybe some more pressure on the deposits because these guys took in a lot of deposits and maybe there was concern that they would go back to the regional banks. But everything kind of stayed steady and credit held up better than people had feared. And their guidance on their future, net interest margins and net interest income came in line. So it's not like the greatest earnings of all time, but also they're perfectly fine where there was a lot of concern that we could start seeing weakness in this sector.
Yeah, I thought it was interesting. I mean, that we kind of went back to basics a little bit and that higher interest rates boosted bank profits, which is sort of what it's supposed to do, right? Even though we were so thrown off by what happened at Silicon Valley Bank. What do we see? You said the deposits seem like they stayed within the big banks. What do we see in terms of lending? Did that seem to be tightening up at all, or does that look like it's still flowing pretty freely?
That was the other one. There was a concern that lending could be pulled back. It stayed basically steady. But with saying that, big banks don't really make commercial real estate loans. That's small and medium-sized banks. So that is what we'll get in the next 2 weeks. So credit looks fine, but this is much more, business and consumer credit. The commercial real estate will come in a week or two.
And how much does this really tell us in terms of the big mega banks, Brendan, when they do well like this? Is this in any way indicative of what regional banks might be bringing to the table in terms of their results as well?
In the past, it would. Now it doesn't because of two big issues. One, deposits. So the banks still aren't having to pay up to keep deposits because all the deposits left the small banks and went into the big banks. So their net interest margins have stayed steady. The smaller banks and regional banks are having to pay more, savings rates to keep the deposits. And then two, it's the commercial real estate loans. The big banks that's not what they do. Morgan Stanley is part of it a little bit, but the mega banks aren't really part of it. There's 1.9 trillion that's lent by small and medium sized banks, and there's a good chance that 33% of those loans are going to go bad, and they're basically huge losses, 80% kind of losses because the property is basically obsolete and needs to be redone or knocked down.
You mentioned the difference in sort of the business focus between Wells Fargo, JPM, and Citi. Wells Fargo more domestic, Citi the most global. Do you see any differences in the performance of the banks based on the location of their deposits? I mean, do you see that is Citi doing any differently because it has a broader global base?
Well, so the Citi's deposits aren't so much the issue. It would have been the loans, especially in the emerging markets, and that's been holding up. And not just the loans, but the business activity. Cross-border transfers and things like that. And Citi reported very, very strong earnings and gave a good guidance for the rest of the year.
It was also surprising to see the trading revenues look so good at JP Morgan.
Goldman Sachs put out a warning that they were going to miss. And really, that's what Goldman Sachs is. They're an investment bank. They do M&A deals and they trade. And JP Morgan especially, it does a decent amount on that, and their trading revenue was in line. So it might just be a Goldman thing. It might not be a sector issue.
Right. Yeah. Morgan Stanley is coming up next week as well, and so we'll get to see that.
Yeah, Morgan Stanley would be more comparable to Goldman than JP Morgan or a Citi. Yeah.
What have we heard from Jamie Dimon, if anything, yet? I know that
so he hasn't talked yet. So that's always the big event, of the week, because he has great insights, but he's also just very glib and pretty honest. So unfortunately, he hasn't talked yet. So we don't know quite what his views on the economy are yet.
Yeah, it'll be interesting to see. I mean, he was kind of, holding out the prospect of recession as a concern on the horizon. I mean, everyone's worried about the recession on the horizon, but it'll be interesting to see if he feels like, the results and what he's seen in terms of business activity is pushing that back at all, or maybe even diminishing the risks of recession, because everyone looks to him as such a bellwether, an oracle, if you will, of what's going to happen in the economy.
He certainly is going to talk, but I would imagine that he probably is going to go on a rant about regulation and higher capital standards. So we'll see about that, because earlier this week, Michael Barr, who is the head of the regulation at the Fed, gave a really important speech where he called for higher capital, as much as 2% at the higher capital ratios at the big banks. This is something we knew was coming, but he solidified and gave a little more clarity on how much more capital he expects at the banks, which is slightly ironic because the big banks were the ones that did fine in this latest little crisis, and it was the smaller banks that actually kind of needed more capital.
What would that do to profitability?
It decreases it. If you got to hold an extra $200 billion in treasuries, that's $200 billion that you can't loan out.
And do you think it also reduces lending?
Yeah. I mean, you only have so many deposits, and if that has to go into a capital bucket, it's not going into a risk-taking bucket.
Yeah, I thought it was interesting in his speech. He not only said that this would apply to the larger banks, but also kind of hinted that this would apply to some of those mid-sized banks as well, the $100 billion threshold and higher. So, this is not set in stone. Obviously, it has to go through a full comment and a public comment period, regulatory guidance, et cetera, proposed guidance. So there's going to be a lot of room for, I guess, discussion around where some of these thresholds should be set and the details of the rules. Right.
And his speech wasn't as bad as a lot of industry, participants thought it could be. So it was a bit of a middle ground. But as you say, this isn't the final version. There's going to be a lot before we finally get it. But this isn't like Dodd-Frank that we have to go through, lots of processes. This is going to be something that's going to be done by the end of the year.
And this is also something that's within the Fed's purview to propose and then to effectively enact. I mean, I guess that was sort of the knock on regulation all along, or since Dodd-Frank and since the global financial crisis, is that, the Fed had the power, to scrutinize some of these smaller banks a little bit more closely. It just chose not to. And so now it's maybe trying to take that step back and say, all right, maybe we need to take a harder look at some of these things and use the powers that were given to us. Because guess what? Otherwise, you have Congress coming in and telling you what you can and cannot do. Maybe, I'm not sure which one is better for the banks, right? Would you rather have, your regulator that you have regular conversations with, being the one that's sort of setting the rules, or do you want Congress to step in and, move with politics maybe at the front of mind versus policy?
Yeah. I think everyone would choose your regulator over Congress setting capital standards.
Well, the other thing I think too about the bank earnings, at least from what we've seen so far, is that, part of the reason that the Fed paused is because it wanted to see how the turmoil that we saw in the spring would play out through the rest of the year. And it's kind of looking like maybe it has played out, right?
Yeah, Waller just gave a speech that said the reason that he voted for the pause was not because he wanted to see what the tightening has done to the economy, but rather he wanted to give time to see if the banking crisis was over tightening the economy. And from the data we've seen, the economy is not slowing, but inflation is. So it's kind of that Goldilocks scenario that we're living in.
Yeah, we're going to talk a little bit more about inflation in just a bit, but John, it seems like the bank earnings coupled with the inflation data that we're going to be chatting about pretty much seems like it means the Fed is going to hike at its next meeting.
Yeah, that's right. I mean, the Fed has signaled as much, and certainly the Fed has, when Fed fund futures have reflected a rate hike, the Fed has dutifully followed through. They don't want to deliver any dovish surprises here with their focus still fighting inflation. But the futures have moved. The Fed came out with those hawkish dots at their last meeting when they paused in June, and focused on the potential for two more rate hikes. Now that has settled back down after these latest inflation figures. That's kind of the big difference over the past week. We've gotten, and that two rate hike narrative was really fueled by that blowout ADP number, which proved to be something of a head fake ahead of, a more moderate non-farm payroll number. And that was followed up this week, as we'll talk more about the lower inflation prints. And it's basically allowed the market to figure the July rate hike as sort of a last kiss goodbye for the Fed in the rate hike cycle of this historically steep tightening cycle, and beyond that, there's some odds priced in for another rate hike a little bit later in the year, but most of the July looks to be it from the perspective of the markets now, and that's a comforting thought, and we've certainly seen risk assets respond positively this week to that soft landing Goldilocks, as you said, dynamic that has taken hold.
All right. Well, we're going to take a short break. That's a good place to sort of leave the discussion for now. And when we come back, we will talk about some of those inflation figures that we saw come out over the past week, as well as a surprise announcement from the Fed that's not about rate hikes. Stay tuned.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at pentagrp, or find us on LinkedIn at Penta Group.
And we're back with the Macrocast. The latest consumer price index provided further evidence that inflation is cooling. Markets have been rallying on those numbers. John, what did we learn about prices and the latest government data?
Yeah, the focus was really on the consumer price index this week, the CPI. We also had the wholesale price producer price index on Thursday, the day after the CPI, and both were expected to show a degree of cooling from the prior month in continuing a trend of easing price pressures. But the positive surprise was basically across the board. Downside below consensus expectation, acceleration on a year-to-year and month-over-month basis, really on both of those metrics. Brendan can dive more into the details, but the broad theme of lots of improvement in the headline number and little bit more stickiness in the core. And that is, while things are going in the right direction, that sticky core dynamic is something that the Fed will use probably as a justification for that July rate hike.
Yeah, but they're really looking very backwards because basically 70% of the increase in both the core and the headline too was the housing components, and that works. It's basically a 6-month rolling average, so that's a very, very backward-looking indicator. That those numbers have just started to slightly roll over, where the real-time data, we know that house prices are down over 10% nationally. So all of that data is going to start feeding into the PCE and the CPI in the second half of the year. So those numbers are going to start to subtract. So the Fed could look kind of silly where they're worried about sticky core, and all of a sudden it could start dropping off a cliff because of data we already know that they're basically just sticking their heads in the sand and ignoring and saying, look at core. where if you actually put the real-time housing data into the CPI and PCE, shows a very, very different story.
Yeah, Fed commentary on inflation has really been monolithic. It has resisted all nuance. It has resisted optimism and has stayed very much on message of the inflation fighting variety. This is, as Brendan says, there's real justification in this data for the Fed to start introducing a little more nuance. But as we've seen, when there's that hint of perhaps the Fed might be done, the markets tend to really get the bit in their teeth and run, and the Fed is clearly worried about unleashing animal spirits and kindling a comeback of inflation. Don't ease too soon is their mantra, I think, and so they want to keep markets guessing about whether there'll be more rate hikes.
So, Brendan, can you help me understand a little bit, because I've been confused by some of the housing data. So mortgage rates are back up to near 7%.
Yeah.
And you would think that would signal, some cooling, because that means that affordability is going to be plummeting, right? But all the commentary that I've seen is that, if there's any slowdown in home sales, it's simply because of a lack of inventory, and that lack of inventory is still providing some, floor level support to prices. So what are you seeing, and why do you think that, we haven't seen broader declines? You said that home prices are down sort of 10%, but, I guess over the past 6 months, they've still been pretty strong.
Yeah, exactly. So things got a little, bubbly there in the pandemic, and especially because people moved into new places. So, in like the Boise, Idahos of the world, where, people moved in, the rental prices and house prices have come off. And also nationally, they've kind of settled down. But because everybody refinanced at, 2 to 3%, you have to have a life event to move out of that mortgage. You're not just like slightly buying a better house across the street, because if you do, you're borrowing at 7%. So there's just not many houses on the market. So when they do come on the market, it's not there's a huge bidding war, but you can kind of hold the price steady. So we're not seeing huge drops in prices, but nor are we seeing very many sales happening.
Do you have any sense of when you're going to start to see that rollover really take hold? I mean, or are we going to be in a period of just tight inventory for a long time because of all those people who are locked into, myself included, an ultra low interest rate that, you took out during either the depths of the crisis or, early on in the pandemic?
Yeah, I think it could last longer than normal because also of the work from home dynamic. You could switch jobs and not have to move. You could take a job in California and stay in DC, So I think it's really gonna take the Fed cutting rates and mortgage rates to come down to get the housing market back to normal. We have a massive, but we also still have a massive shortage of housing. We just haven't built enough houses. That is picking up. The home builders actually are one of the best performing stocks in the last 3 months. And new houses are getting bought, but we honestly just don't have enough people to build the houses that we need.
Yeah, and I wonder too how much of this is. I mean, we always talk about monetary policy, right, as a blunt instrument, but the Fed raising or cutting rates is not going to change the fact that, again, you can work from home and change jobs without having to leave the town that you're in, and maybe some of these more fundamental factors within the economy that mortgage rates or interest rates don't really affect.
Yeah, and the same with the commercial real estate market. So, because rates were so low for so long, you could buy a property and only need a 5% cap rate. So you only needed to get 5% return. That was attractive. Right now, you can get a 5% return by just buying a treasury bond. So all of these properties that people don't need anymore are obsolete. So the commercial real estate people that bought the building, when people move out of the building, they just give it back to the bank because it's completely economically unprofitable for them. They can't make it work. So you just have to wash your hands of it, declare bankruptcy, put it at the bank. And then the bank is stuck with it, and it's basically a worthless property.
I was just looking up a headline that I saw earlier in the week that says Boston offers tax breaks to turn empty offices into housing, which seems like it would address both of those issues.
And it's like a 70% tax break. So the Boston mayor is fairly dynamic, and she understands what a kind of crisis is coming and is trying to get out in front of it.
Yeah.
One of the things that you pointed out before, Brendan, is that it's really hard to turn commercial space into residential.
New buildings you can't do. Old buildings you can. It has to do with the plumbing and mainly the air conditioning.
I was going to say you need more bathrooms.
Yeah. But the open concept space, the way you air condition it, you can't then build a bunch of smaller apartments in it. So it's just very, very difficult. It's just physics basically. So a lot of these buildings, you can't just turn them into residential. You got to knock them down and start all over again.
Wow, that's fascinating. This is one of the reasons why I love doing the Macrocast, guys, is because I feel like I learn so much every week, and it's not always pre-planned, with the topics that we're going to discuss or where we're going to go. The other question I had, and see, this is just going to be my personal prerogative here. The other question I had, John, around CPI is how much of the slowdown is really just a base effect, I guess, if that's the right term, which is what we saw last year or this time last year, a year ago, right? Was just massive numbers, inflation numbers, a massive spike in prices. And so, you would assume that you wouldn't see that again. So is the benefit really just about comparison, or is the slowdown more real?
Well, we would look. Yeah, you're absolutely right. It is flattering on a year-on-year basis, and the comparisons are getting easier. So focusing on the month-over-month pace, and so when you look at that, it's it was 0.2% month-over-month in June. That was 0.1 the month before.
0.18, which is the lowest we've had in a long time.
Yeah, those are not particularly scary on a month-to-month basis, and that's kind of what the level the Fed would want to see. And so, you definitely want to look under the hood at the month-on-month to give you a sense of whether this improvement is cosmetic or fundamental.
Yeah, but the PPI, the producer price index, on a year-over-year basis was only up 0.1%, so it was flat. So and the PPI leads the CPI by 4 or 5 months. So we do have disinflation coming in the pipeline.
Great, that's encouraging to hear when you guys again sort of dig a little deeper into the numbers and can explain why we should be maybe a little bit optimistic. Want to switch gears now to talk about some changes that we're hearing out of the Federal Reserve. There's been a lot of personnel movement in the Fed, sort of a surprising amount over the past week. In Washington, the Senate Banking Committee cleared current Fed Governor Philip Jefferson to be vice chairman and approved Lisa Cook for a full term as governor. The committee also advanced Adriana Kugler to become a Fed governor, making her the first Latina to serve at the board if she ends up getting confirmed. And all three are still going to need to be approved by the full Senate, though it seems likely that they would get full confirmation. But the bigger change that we saw this week is going to be at St. Louis, where Fed President Jim Bullard announced he is stepping down to become dean of Purdue University's business school. This was honestly kind of shocking news to me when you were the one who told me, John, about this, because he is the longest serving Ford president, I believe, at 15 years. In that role. He's been at the St. Louis Fed for over 30 years. And I mean, I remember him from when I was covering the Federal Reserve as a sort of very vocal and very animated Fed bank president. So this could have some big implications.
He was always notable and quotable. That is for sure. I was a little surprised to see, that's a really great position, and congratulations to him but maybe I was kind of a little surprised that he wouldn't have such a megaphone. He seemed to like the limelight, and he was really, almost, it seemed like, reflexively contrarian. I think a gadfly, I think I've called him, which is not, which is probably a little too pejorative, but he was always the out of the box thinker. He was, not always right, obviously, who is, but he was pretty early on the hawkish tilt for this past inflation fight, and so I think that he's gone out on a high note in terms of his credibility ability and where he has positioned himself on the committee as the the resident hawk in a pretty hawkish time for the Fed.
Yeah, I think it was that first meeting when they began to raise rates, as we were coming out of the throes of the pandemic, and the committee voted to raise rates by 25 basis points, and he dissented because he wanted a bigger hike. I mean, that's kind of unusual within the sort of stately corridors of the Federal Reserve.
Yeah, he swam against the current, and it wasn't always in the same direction, which makes it somewhat unique. Usually when you have someone on the FOMC, that they're sort of like a dependable dove, a dependable hawk. You sort of know where they are along the spectrum. But Bullard has really been on both sides of that posture, and so you could never pin him down. He was obviously a very critical thinker, and kept things pretty interesting on the Fed board for a long period of time. So best of luck to him in his new endeavor.
Yeah, you can say at least that he resisted groupthink, right, and sort of pushed his colleagues to think in different ways, to consider different positions, and so that serves its own purpose, and that's a benefit as well. So congratulations to former President Bullard. I saw some reporting that he will be abstaining from participating in the next FOMC meeting. He's not a voting member this round, but he's going to be staying out of monetary policy until he joins the staff of Purdue University in August, I believe it is. So some big Fed moves there. I feel like there's been a whole new, almost, I don't want to say generation, but a whole new roster of Fed players and Fed officials over the past few years. So that'll have important impacts, I think, for monetary policy, because, we think it's not just about the models and the economics, it's also about the compromises and the discussion amongst the people who are making the policy, and that can shape the direction of the Fed's actions. So important things to watch. But what else do we have on the radar screen, Brendan? What's coming down the pike over the next week?
So we get U.S. retail sales, which is kind of the third big data point that markets can move markets, and then a host of European inflation data, also in Japan, and then China's GDP data is coming out, which China hasn't been doing so great as of late. They even their exports were down in the last balance of trade data. And then we continue with earnings. We got Goldman, Bank of America, Morgan Stanley, American Express. That'll be an interesting one. And then Netflix, which is always fun, and Charles Schwab. So Charles Schwab is another one that is their deposits are an important part of their business model. So that'll be another important one to watch to see how their deposits are holding in.
Great, John. Anything that you're going to be watching?
Let's see. The certainly going to be looking at the retail sales. I mean, that's a key aspect of a pillar of growth, the consumer resilience, and any signs of that the U.S. consumer is beginning to suffer the ill effects of prolonged elevated inflation or any of the other headwinds. That would be certainly a market moving data point.
Great. Well, consumers so far have stayed strong, and we hope that our listeners are staying strong too during these dog days of summer. That does it for us today. I'm Ylan Moy with Penta. My co-hosts are John and Brendan from Markets Policy Partners. We hope you all enjoyed our show, and please remember to like and subscribe to the Macrocast wherever you get your podcasts. Thank you for listening.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.